Okay, namaste candidates. Welcome to chapter 7 of FRM part 2 market risk. So in this session we'll dive into something every risk manager needs to master, needs to understand properly. How we test and validate VAR models. So we have all heard of exceedance based testing, okay, which we have covered extensively in the previous chapters, where we simply count how often the actual losses they exceed the model's predicted VAR value. Okay, but see, here's the thing, that approach, it's just the starting point. Okay, in this chapter we go beyond that basis uh, idea, the basic idea of, you can say, pass fail thinking. We go into a more deeper, more nuanced way of validating models. We'll explore PIT based backtesting, interpret their model behavior through the shape of the distributions, bring in tools like different kinds of tests are there. Okay, all this will be done to assess not just whether a model is accurate, but how and where it might be misfiring to some extent or maybe a large extent. Okay, so if you're ready to level up with your with your understanding of model validation, we can get started now. So let's quickly run through what you'll all take away from this chapter based on the GARP core learning objectives. Okay. So first you will learn the core properties of exceedance based backtesting. So this is the traditional method where, as I said, we simply count how often the losses exceed the VAR. But the goal here is not just to stop at this point. Okay. We'll also connect this idea or these ideas, the set of ideas, to the more powerful PIT based approach. So we'll actually explore how to derive the the PIT values. We'll see how the PIT values are computed, and see, you might have heard. I mean, if you have an idea, most of you might be doing this for the first time, since this is the third new chapter which has been added this year. Three chapters in market risk have been added. This is the third one. So if someone has an idea about PIT, you might have heard someone say that PIT is just the CDF. So don't worry. Okay, it's actually not just the CDF. Okay, but yeah, it is quite analogous, and don't worry at all. We'll break it down clearly step by step. Third, we look at the distribution shape of the PITs and how it can signal if a model is too conservative, say too aggressive, or just right. Now, visual interpretation is very important over here. And finally, we'll compare different goodness of fit tests that help us assess how well the PIT values they follow a uniform distribution. So these will include tests like KS, which stands for Kolmogorov-Smirnov test. Okay, then you will have AD, which stands for Anderson-Darling test. Okay, and this is CVM, which stands for Kramer von Mises test. Okay, so each of these topics, they will try to build on the other, and so by the end you'll be equipped with a full kind of toolkit for validating VAR models the smart way. Okay, let's now discuss the properties of exceedance based backtesting and how those same principles are reflected in PIT based approaches. So we start with the core idea. See, exceedance based, now this point has been repeated multiple times throughout the lecture, and even when we do PIT, there will be points like, for example, the uniformity of the PIT distribution. It will be discussed multiple times throughout this lecture. Okay, so that since that the point is very, very important, you will be able to internalize that point quite easily if we repeat it multiple times. Okay, with different perspectives, of course. So we start with a core idea, as I said, exceedance based backtesting. It checks how many times the actual losses exceed the model's predicted value at risk. Okay, or VAR. Let's say a 95% VAR. Okay, so if you have a 95% VAR, in theory, you will expect the losses to exceed the VAR value about 5% of the time, and that is what we call as unconditional coverage. So it simply means that the model's hit rate, it should match its stated confidence level. Okay. Now, if you have too few exceedances, it means that the model is too conservative. If it is too many exceedances, okay, then it is underestimating risk. And there are also a few more important things, the properties which we need to understand for model accuracy. So, see, one thing is important that we care, actually, we care a lot about the independence of exceedances. So these breaches, they should occur randomly over time. Okay. They should be randomly distributed over time, not in clusters. So if you see one exceedance followed by several more in a row, let's say, that suggests that the model is not adjusting to the changing market conditions. It's actually misfiring. Okay, and of course, we don't want any kind of systematic bias, because a model that always over predicts or under predicts is not reliable. If the model is over predicting risk or under predicting risk, you cannot rely on that model. As I said, a low exceedance rate will mean that the model is overly cautious. Okay, overestimating the risks, and a high rate means it is taking too much risk and it is underestimating risk. So either way, it should be off. It actually is not a good balance. It's off balance on both sides. So we have to try strike a good balance. And of course, as I discussed, unconditional coverage is the straightforward idea that the if suppose you have, say, a particular VAR with a specific confidence interval, okay, or confidence level, sorry. So in theory, you should expect the losses to exceed that VAR value about 1 minus confidence level amount of time. Okay. Now, how do these properties reflect in a PIT based backtest? Okay. So PIT based backtesting, it expands the evolution to the full loss distribution. Okay. So instead of just counting exceedances, in fact, what we can do, we can, uh, because this is a generalized topic, properties of exceedance base, and under this only we have discussed the properties of PIT base. So rather than exceedance base, we can write this as this heading as properties of PIT based backtest. So instead of just counting the exceedances, okay, PIT based backtesting, or PIT based testing, it examines the entire distribution of forecasted losses. So here we transform each observed loss into a PIT value, that is the cumulative probability under the model's distribution. Okay. Now, if the model is well calibrated, those PIT values will follow a uniform distribution between 0 and 1. So standard uniform distribution. Okay. We also want to see no autocorrelation in the PITs over time. Okay. So just like exceedances, PIT should behave like independent random values, particularly over time. Now, if of course they show patterns, trends, or different kind of cycles, it will clearly imply model misspecification. Okay. One of the biggest advantages of PIT based backtesting that it checks for correct tail behavior. So in other words, does the model predict or properly estimate extreme losses, not just the average ones? So this is important because exceedance based tests only evaluate a single quantile, like let's say 95th percentile. But PIT tests reveal, you can say subtle flaws in the tail estimation and distributional assumptions that basic backtests might completely miss. So what's the bottom line? What's the bottom line? Exceedance based tests are essential, but they are limited. PIT based tests, they are broadening the lens and they are exposing deeper issues. So it is always better that, they are done together. So together they give you a much more complex validation framework for any VAR model, and it strengthens model validation. Okay, so how uh, the derivation is done for PIT values. Okay, since we have understood why exceedance-based backtesting alone is not enough, we should try and see how we actually derive the PIT value. So PIT stands for probability integral transform, and it is used in this VAR model validation to check whether the entire predicted distribution, not just a single quantile, as I said earlier, it should align with reality. The entire distribution should align with reality. Okay. Now, this is the key. See, as I said, traditional backtesting is only checking whether your model is right about the threshold. 95% cutoff, 99% cutoff, and the PIT based methods, they are going much deeper and they go beyond. That is why the name of the chapter is beyond exceedance based backtests. So they go beyond the traditional backtesting methods. Okay, they go much deeper. They analyze the full loss distribution. The full distribution of loss is analyzed. So instead of asking, did the loss cross the line? Okay. Now what we ask where exactly in the distribution did the loss fall? Okay. So let's break down this into steps. So what is step one? Step one is to obtain the forecasted loss distribution from a VAR model. Okay, this comes directly from your VAR model. So whether it's based on historical simulation, parametric assumptions, or Monte Carlo. At each time, the model will give you a forecast, not just a single number, okay, but a full probability distribution of potential outcomes. Then this is where step two will come into picture. So from this distribution, we compute the CDF or cumulative distribution function. Okay, now this function, which if you remember, we denoted cumulative distribution function as capital Fx. Okay, it gives us the probability that any realized loss is less than or equal to a certain value. So it is this CDF which allows you to translate an observed loss. Remember, we are using the CDF to translate observed loss into a PIT value, not a theoretical loss which was predicted by the earlier distribution. Because if that is done, then there is no point of performing this exercise. You'll always get a perfect result without any doubt. Okay, so we'll see this in the next step. Let's move forward and just try and complete the derivation. Okay, now let's continue with step three. And this is where we actually compute the PIT. Okay. So once you have your predicted distribution and your observed loss, you apply the model CDF to that loss, to the actual loss, to calculate the PIT value. Okay. So for day, say small t, for day small t, for each day small t, let's say, you plug the realized value xt into the CDF capital F, which you write like this, ft capital xt, and this gives you a number between 0 and 1, telling where the actual loss lands within your predicted distribution. So think of it like this. If your PIT is 0.9, it means that the actual loss was uh, say bigger than what your model expected 90% of the time. Okay, so it's basically percentile rank of your observed outcome under the model's forecast. Now, step four is about interpreting these PIT values. So if your model is correctly specified, very, very important point, which I said will be repeated multiple times throughout this session. So if your model is correctly specified, well calibrated, then these PITs should be uniformly spread between 0 and 1. Now I think Garb should have emphasized the logic behind this completely in detail so that there is no confusion left whatsoever. I'll try to explain this in an intuitive way because I'll first raise a counter question, okay, and then I'll try to explain this in an intuitive way so that you can understand why. Okay, so in other words, basically over many days, you should see that, PITs are evenly scattered across low, middle, and high values. Okay, so as I said, let's deal with this intuitively because when I studied this for the first time, I mean, not in the FRM curriculum, it was some time back actually. where we were dealing with PIT. So the first thing that came to my mind was, you know, if suppose if it's given that losses we are using the CDF only. Now my point was that if losses mostly see if you have a distribution, okay, the predicted distribution is, let's say, a normal distribution with a mean of 0 and standard deviation of say 2, for example. So obviously, if the predicted distribution is like that, then the model will be correct if the actual distribution also is very close to the predicted distribution. There is no doubt about that. Okay. And probably that could have also been a way of checking the entire distribution, but actually PIT makes your job easier. So if the predicted distribution tells you that the mean of the loss distribution is 0 and standard deviation is 2, so don't you think that, and that is the question that came to my mind, that the PIT values should also be clustering around 0.5 too much? Why uniformly spread? It feels very logical, right? Quite reasonable. Because mostly the actual loss distribution, if it has to follow very close to the predicted distribution, so many values will be around 0, and 0 means what? If 0 is as far as the PDF is concerned, if you are getting most of the values around 0 in the PDF, it means that the CDF, the most of the value should be clustered around 0.5. So this is something which came to my mind. But see, try and understand one thing. The CDF itself accounts for how common different levels of loss are. And if you remember the shape, let's say, as I said, the prediction is something like this, okay, of the loss distribution, something like this, okay, a normal distribution. Sorry, there's some lag in the pen. So a normal distribution with a mean of 0 and standard deviation of 2. So obviously, if you remember, the CDF is something like this for a normal distribution, right? It is steepest at the center. Right? There's an inflection point also, anyways. I'll not go into that. So it is steepest at the center, at around the mean. So it effectively spreads out the many typical losses around a wider section of the 0 to 1 interval, while compressing the rare extremes into smaller probability ranges. So when you actually apply the CDF to your actual losses, it flattens out the curve, and it translates your observations into evenly spread percentile ranks. Because see, in any case, the losses which are there in the around the center, okay, the probability also, see, the center is also quite thin. Okay, so 0.5, if you are having, I mean, let's say many losses are spread across the center, you can be rest assured that even though more losses are there at the center, but because of the CDF being much steeper at the center, actually it will follow a much wider range at the center and narrower range at the extreme. So it will become uniform completely. Even small deviations around the center might be actually giving you CDF values which are having higher variation. You can see that over here. Okay, you can see that over here. CDF values are vertical, right? So for small changes, the CDF values are changing more. But over here for small changes, the CDF values are barely changing. So yes, these are rare events, but still it's okay. If these are rare events, then in any case, CDF from here till here will change a little less, and we'll get very few values on the left tail. Okay, so in any case, the distribution will make sure that your losses, the PIT value corresponding to your actual losses, are well spread. Okay, and that is why the uh, uh, the observations are actually getting translated into evenly spread percentile ranks, and that is why the PITs is, under a well specified model, they will look uniform. Okay, not this bell shaped or the CDF shaped kind of thing. Okay, see. Because if suppose this is not happening, if you see too many values uh, clustering across any number, say 0.5, you would imply that your model is too conservative, it is over predicting the losses and all. If you see the PITs stacking up near say 0 or 1, okay, it will imply poor tail risk estimation. Okay, you also have to watch for autocorrelation, because if PIT moves in trends over time, it will suggest that, just a minute, I'll just select this. It will mean that the model is not adapting to changing market conditions because of autocorrelations or dependencies from the past. So this step does not just give you a number. It's a very powerful diagnostic tool to see where and how your model might be misfiring. And we'll discuss a few things in another slide also, where we see the differences and the applications as well. So we'll see this in great detail. What are the entire implications from different shapes of the PIT distributions? Okay. Now let us do one thing. Let's go for some kind of an example. So the application of this in VAR model validation, if you want to discuss, see, by plotting the empirical distribution of PIT values and testing for uniformity, like using that Kolmogorov Smirnov or test, or even QQ plots. We have seen QQ plots also. QQ plots also actually analyzed the empirical distribution with the theoretical distribution, if you remember. So that is also one of the ways. So using these methodologies, financial institutions, they can evaluate whether VAR model provides accurate probability forecast across different quantile. Okay, not just a fixed confidence interval. And this approach, it captures both central patterns and tail risk behavior missed by the exceedances tests. So as I said, let's take an example, the application example. So deriving PITs for validating a PR model. So we'll take a very simple example of a bank which is monitoring daily portfolio losses using a VAR model. Now the bank estimates the 1 day ahead loss distribution and checks whether its model is correctly predicting risks. Okay. So step one is obtain the forecasted VAR distribution. Okay, so this is the assumption. Suppose that the bank's risk model forecasts that daily losses will follow a normal distribution with the expected mean of, or mean of 0, expected daily loss is mean of 0, and expected daily variation or standard deviation of 2. Okay, so if this is the case, now we can just do a very plain mathematics. If this is the case, the model will predict this. The model will clearly predict 95% VAR equal to 3.29, because it's 1.645 times 2, and 99% VAR is equal to 4.66 because it is 2.33 times 2. So this means that the model expects 95% of daily losses to be below 3.29 and 99% of the losses to be below 4.66. Okay. Now, step 2, the bank actually tracks actual losses over time and compares them with the predicted distribution. So let's say day 1, the observed loss becomes 3.0. The model will estimate that 92.7% of the losses are should be less than or equal to 0. Okay, based on the CDF of that normal distribution that we just discussed. Okay. This is what the model will predict. So basically this means that according to the model, 3 falls at the 92.7 percentile of the expected loss distribution. You can verify this using Excel also. It will be quite clear. If you have a uh, normal distribution with a mean of 0, standard deviation of 2, you can clearly check that 3 for 3 you will get the percentile as 92.7. We have done this in detail in part 1, right? So then step 3, apply this PIT. Okay. So for day 1, we calculated the PIT. So what is PIT? PIT value is the percentile rank of the observed loss. So day 1 PIT was how much? 0.927. Okay. This loss is larger than expected, but not extreme. Expected loss was of course 0. And in fact, it falls below the 95% VaR because it is 92.7. Remember, it is 92.7. So I'm just again repeating. So this 9.927 actually could have been written like this. So F, basically we are trying to find out F of 3, where your PDF is for a normal distribution. Okay. So losses are normally distributed with a mean of 0 and standard deviation of 2. Okay, so loss is larger than expected, but not very extreme. Now, day 2, the observed loss is, let's say, 1.5. In this case, again, if you apply this transformation, you input 0.69 in the F capital F function, you will get 0.69. Again, this can be checked either using the Z table or you can use the Excel. So this loss is quite smaller than expected, and it's in the lower 69% of the distributions. Let's say on day 3, the observed loss is 5.2. And in this case, PIT becomes 0.995, which is an extreme loss, which is greater than 99% of the predicted values, or a very extreme case. Okay. Then step 4, we have to interpret the PIT values. If the model is accurate, all these values on consecutive days, see, whatever we are getting, 0.927, 0.69, 0.995. So if you repeat this over a period of many, many days, in fact, you can use Python or RStudio where you can have, say, 10,000 sample points. You will clearly see that over a long period, particularly if you have 10,000 sample points, it will definitely become uniform. Okay, I'll definitely try to uh, demonstrate this. Of course, not a part of this chapter, maybe another technical kind of course or a technical video I'll upload where I'll try to show this, that over a period of 10,000 days how it can happen. Okay, or even say 1,000 days, what kind of shape we can achieve. So remember that if the model is accurate, the PITs will be uniformly distributed. Some PITs will fall near 0.1, some near 0.5, and some near 0.9. Now again, I'm saying you might be tempted to believe this, that many will be near to 0.5, but the intuitive explanation that I gave, go through that explanation once again. If you're not clear with that, do some research, think with a very, very calm and cold and composed mind, I should say, and then you will be able to understand why this is true, why they will not cluster around 0.5 if the model is accurate. Okay, they will be uniformly distributed. Okay, so as I said, this part will be discussed in more detail in the next table as the part of the third learning objective of this reading. Okay, so let's go to the interpretation of the shape of the PIT distribution. Okay, now let's interpret what different shapes of the PIT distribution tell us about our VAR model. Now, if the PIT distribution, the PIT values are uniformly distributed, that's the gold standard, right? It means your model is very well calibrated. There is no systematic over or underestimation of risk. Losses fall across the predicted distribution just as they should, right? Now, if your PIT values cluster near 1, meaning that you have a right skewed PIT, it signals that actual losses are larger than expected. So in short, your model is underestimating the risk. On the flip side, if PIT values cluster near 0, that's a left skew. It means actual losses are mostly smaller than what the model anticipated. So your model is overestimating the risk. Okay. Now, what if the PIT values cluster in the middle around 0.5? That suggests that your model is too wide or conservative. So a wide conservative model, it spreads risk out too much, too much, and it underestimates how often we get tail events. Now consider the case when PITs cluster at both extremes near 0 and 1. So this implies that the model is actually too narrow. The forecasts are too narrow or aggressive. Now, any narrow or aggressive model will push too much weight into the tails, overstate the tail risk. and overpredict the extreme outcomes. It will concentrate the probability too tightly in the tails. Now, if you see a peaked PIT distribution with high kurtosis, whatever you may call it, it means that the model is not adapting well to volatility. It underreacts to market changes, which makes it unreliable when markets become turbulent. And lastly, if the PIT values show patterns over time, like trending upward or downward, it signals that the model fails to adjust to evolving market conditions, not adaptive at all, and it the risk estimates will be too static, which will create a lot of systematic biases over time. Okay, so simply by analyzing the shape of the PIT distribution, you get a powerful diagnostic to identify whether your model is too tight, too loose, lagging behind market shifts, or fundamentally misspecified. Now, this particular slide, we have done a lot of research, and the level of detailing which is there in the PIT behavior, it's actually not even there in the GARP book, and it was very difficult to find the exact behavior of PIT and how its relation is to risk for all these cases. You may find only three cases or two cases, three cases max, I think, in the GARP official text and even in other books. So make sure that you understand this properly, and every single detail should be clear to you. Okay. Okay, let's now discuss how we backtest with probability integral transform. So this is closely tied to what we explored earlier. Okay, we just don't care about the whether the losses breach a single VR threshold or not. We want to see if the entire predicted loss distribution matches with what actually happens. Okay, so we go beyond single VR breaches. So if your model is well calibrated, you will have this kind of a structure where the PIT values that you compute over many days, these the percentile ranks of observed losses we talked about in the last section, they will be evenly spread across or between 0 and 1. So you'd expect some near 0.1, let's say some near 0.5, some up at 0.9, all roughly balanced basically. Okay. So this is a sign your model does not consistently underestimate or overestimate risk. And if suppose you actually see the PIT is piling up in certain ranges, say mostly in the middle or clustering near the edges, just like in the previous slide we saw, it tells you something is off. So that's the classic red flag of model misspecification, meaning that your model might be too conservative, predicting large losses that rarely occur, or too aggressive, underplaying the real tail risks. So the PIT values gives you a full picture of how well your model captures all possible outcomes, far beyond just the counting exceedances. And uh, what are the steps that are involved? Okay, so these are the steps that are involved. So we actually compute the PITs using CDF of losses. We plot the PIT histogram for uniformity, and we run the goodness of fit tests, and we'll see the three goodness of fit tests after this slide. Okay. So several tests are available to check if our PIT values are actually uniformly distributed or not. Uh, let's look at the first and most widely used of these, the Kolmogorov-Smirnov test, KS test. So as we have seen before, we want our PIT values to look like they are drawn from a uniform distribution between 0 and 1. So the KS test checks exactly that. It compares the empirical CDF of our PIT values to the expected CDF under uniformity. So how does it that? How does it do that? What does it actually do? It actually measures the largest absolute difference between empirical CDF of PITs and uniform CDF. Okay, so the largest absolute difference between these two CDF values, they are measured. Okay, so in other words, it actually points to, or you can say it finds a point where the actual PID distribution and the perfect uniform distribution are furthest apart. Okay, this is the test statistic. Mathematically, it is written like this: maximum of Zi minus Ai absolute value for all I. Okay, and of course, Zi is the theoretical CDF under the null, which is uniformly distributed between 0 and 1. That's the theoretical CDF. It should be uniformly distributed, and AI is the empirical CDF, the actual value that we are getting from our PIT data. Okay, so if your PIT values truly follow a uniform distribution, then this D should be very close to 0, which means that your model's PIT distribution does not stray much from what we'll expect under perfect calibration. Now, why this KS test is so popular? Because it's simple, widely used, and it is very good at spotting large deviations. Okay. But of course, it does come with some limitations. It is less sensitive to differences in the tails, which is often where financial risk hides in practice, right? And it also picks the maximum gap, so it might ignore smaller but systematic shifts elsewhere in the distribution. This is why we'll see other tests like AD Anderson Darling. They'll give more weight to those tails. Okay, so just let's go to the next slide. We have the second test. We'll move on to the second test, the AD test or the Anderson Darling test. The AD test is essentially a refinement of the KS test that we discussed, and it does something clever. It actually refines the KS by giving more weight to deviations in the tails of the distribution. Okay, this is actually important in risk management because we often care most about extreme loss events. We have seen this multiple times right from part 1. Okay, and in part 2 it has been emphasized even more. So you will see this statistic over here, this statistic in this slide. Okay, it looks more complicated than the case, of course, because it involves logarithmic terms that emphasize tail differences. Okay, and of course, just like earlier, Z is the ordered PIT values, and N is the sample size. Okay. So what's good about AD? AD is better at detecting misspecifications in the tail, which is exactly where many risk models struggle. Okay. That makes it especially useful for banks or funds that want to ensure that they are properly capturing the extreme risks. Okay. And on the downside, it is of course more complex than the ALS KS. It is more complex to compute than the KS statistics. It also tends to be less effective for picking up small systematic shifts across the entire distribution. Okay, it is actually only tuned to the tail region. So it's tuned to spot tail issues. So let's cover the last test, the third test, the Kramer von Mises test, or simply CVM. This, I'm not sure if I pronounced it correctly. You can just check the pronunciation later on. So this one takes a slightly different approach from the previous two. Instead of looking just at the largest gap like the KS or emphasizing the tails like the AD, the CVM test measures the average squared difference between the empirical and expected CDFs across the entire distribution. So it's a more of a global test. Okay, it tries to see overall how far off the shape of your observed PIT distribution is from what you'd expect under a perfect uniform. Now, the formula involves two parts. The first term adds up the square deviations for each ordered PIT value. And the second one is the scaling adjustment to ensure proper normalization. So in the formula, of course, Zj is ordered PIT values, Zj are ordered PIT values, and it's the sample size. And this W square formula, okay, it captures, as I said, the square deviations plus a scaling term. Okay. So this entire sum captures how the ideal PITs deviate from the ideal uniform position. So again, what are the strengths of This CVM, what is good about CVM? It does a very nice job of capturing the overall shape differences, not just isolated large gaps. So it's kind of balanced over the entire range, making it excellent for spotting general non-uniformity, not only in the tails, general non-uniformity. But of course, it's not perfect. It's less sensitive to specific problems in the tail. So if your model underestimates extreme losses, CVM might not catch it as sharply as AD. Plus, it is much more computationally heavy than KS. Okay. So each of these tests has its role. The KS is simple, picks up big deviations, AD zooms in on the tails, and CVM gives a kind of a holistic look at how well the whole distribution lines up. So it's better to compare the three again. Okay, all the points we have discussed. Let's just wrap up this chapter by comparing these three goodness of fit tests side by side: the KS test, the Anderson-Darling test, the Kramier-von Mises test. So starting with the KS test, it measures the maximum absolute difference between empirical CDF of the PIT values and the uniform CDF. Biggest strength, simple, widely used, and great at picking up large deviations. But of course, it is limited. It does not really care if deviations are in the tail or in the middle. It just picks up the biggest gap. Okay, so it's insensitive to tail deviations and completely ignores the overall shape beyond that maximum difference. Then we have the Anderson-Darling AD test. This one improves on the KS by applying more weights on the tails. This is important, as I said, for risk management where we care deeply about the extreme losses. Okay, so it's better at spotting misspecifications in the tails, making it especially useful for financial risk models. And it is more complex than the KS, and it still may miss some small systematic deviations in other part of the distribution. Finally, you have the CVM, which looks at the average square differences across the entire distribution. This means that it is much more balanced, capturing deviations across the whole range, captures overall distribution shape. Okay, and it is actually, you can say, it's not only since it is more balanced, it is capturing deviations across the whole range. It is not only capturing the extremes, so it's great for testing the overall shape. But on the downside, of course, it is less sensitive to specific tail issues, and it is also more computationally intensive than something like the KS. Okay, so putting it all together, each test has a slightly different lens. KS is simple and flags the biggest gap. AD zooms in on tail problems, and CVM balances out the whole distribution. And that's why in practice, many institutions they run multiple tests together to make sure they are not missing any red flags in their PIT analysis. Just like we discussed in the beginning, many institutions run both exceedance-based test and PIT-based test as well. Okay, that brings us to the end of this lecture on beyond exceedance-based backtesting of VAR models. So in this session, what we did, we moved beyond the standard exceedance counts and we explored a much richer framework using probability integral transforms or PIT. We saw how these PITs were allowing us to examine the entire predicted distribution of losses, giving us a lot of insight into whether our VAR models were well calibrated and not only at a single confidence level but at all quantiles, across all quantiles. We also looked at how the PIT, where this was emphasized multiple times, why the PIT should be uniformly distributed if the model is correct, and how deviations from this kind of uniformity, clustering, extremes, trends, all these things, they signal different type of model problems. And finally, we reviewed the goodness of fit tests like KS, AD, and CVM. Each of them were having their own strengths and weaknesses in detecting calibration issues. So that's it. This is wrapping up this chapter from FRM part 2. So keep practicing these concepts. They are not just exam critical, they are also core tools that you will use in real world risk management to ensure that your models, and particularly if you are in model risk, okay, if you are in model risk management, then definitely this chapter is quite useful to you. So you'll have to ensure that the models are not quietly misrepresenting the risk. Okay, fine. Thank you very much. I'll see you in the next lecture. Namaste.